Hi everybody, Lance Browning, Income Solutions, Wealth Management in Tyler. Welcome to our 2016 halftime report. Glad to have you. Thanks for tuning in. You know, it's hard to believe that I'm about to start my 20th year in practice. It's crazy. And don't let the boyish good looks fool you. I've been doing this a while. But it's also hard to believe that we're almost halfway done with 2016. Well, let's get this road trip started. And I think one of the things that's always helpful to do is maybe take a step back and see exactly where we are so that maybe we can map out exactly where it is we're trying to get to. And where we are is pretty much exactly where we started. We've been in about a 22-month, about a 2-year kind of range, very tight, where we start and stop at the same place. It's sort of like a roller coaster. We've had a whole lot of media fanfare and hype and hoopla. We've gone up to our highs, we've gone back down, we go back up to our highs, we go back down. And it's like that roller coaster where you go up, you go down, but you start and stop in exactly the same place. And that's where the market has been for about the last 2 years, 22 months or so. And if you've been taking withdrawals from your investments, this is challenging because you haven't really had any growth in the market, even though you're taking income, even though you're taking withdrawals. It's been challenging if you're not taking income and withdrawals, but it's frustrating there too. But it's been extremely frustrating and challenging if you have been trying to take income off in a flat market. And you see all these headlines, and we look at sort of the fundamentals. What are corporate profits? What are corporate earnings doing? And also, what is the U.S. economy? And what is really the world economy doing? Are they growing? Are they slowing? And we're going to look at that. And I sort of talk about my joke here, fundamental schlundamentals, because we haven't really been driven by fundamentals anytime recently. This is the LPL earnings dashboard, kind of keeping with our road trip theme. You'll see on the left, you're going to see revenue growth. Corporate revenue growth down year over year about 1.9%. Over on the right, you're going to see EPS, or earnings per share growth, down about 5.2% year over year. We've actually technically been in an earnings recession where earnings continue to go down. Ordinarily, you would think that as earnings grow, as profits grow, as the U.S. GDP goes, so would go the stock market, and that really hasn't been the case. And I believe that a lot of the earnings, quote-unquote, growth over the last several years has been due to a couple things. First of all, being share buybacks, companies buying back their own shares of their own stock, as well as corporate cost cutting to get their expenses down. And even now, as we see, that's not really helping or having any effect. This, and you'll see this little tail right here, where corporate profits are, and you're going to see we're sort of below that flat line. Again, this illustrates that we're in a profits or earnings recession where earnings are actually shrinking on a year-over-year basis. Typically, that's not a good thing for the economy, and typically not a good thing for the stock market. And this is GDP. So this is what we call GDP, gross domestic product. This is the bottom line report card on the stock market. Okay? So what you're seeing is a market at basically stall speed at a flat line, not really growing like we need it to grow. If this were your kid's report card that he's bringing home from school, we've been sitting at about a D plus, C minus here for the last couple of years. A lot of volatility, a lot of hoopla, a lot of up and down, but we start and stop at basically the same point. This is world GDP. This is the entire global economy and how it's growing. And you see sort of North America, the U.S., and the entire world. Here in the bottom left, you're going to see where the world total only at about 2.7. Again, that's probably a little below what we would call stall speed. You're not really climbing and growing like we need to be able to grow. This is not a really good report card that you can base a whole lot of market growth and investment growth on. So if earnings are slowing down or in a recession and GDP is basically flat, why does the stock market continue to go to a high, back down, then go to a high and back down? Well, the answer is probably going to be the Federal Reserve. And this is, again, with our road trip theme. Car's kind of broken down here, and Janet Yellen, she's the chairman of the Federal Reserve. She is basically pumping money into the engine here. So between money printing and zero interest rates, the Fed is trying to keep the economy going as best it can. Even with all that, we're still kind of plodding along at stall speed. And you're seeing this globally as well, not just with our Federal Reserve, but with other central banks around the world trying to flush liquidity, money, free money, easy money, zero interest rates, in some cases negative interest rates, through their economy, trying to get them to grow. So what do we think? What's going on really? This is something that I saw a couple of weeks ago at a conference, and I thought this was very, very interesting. This is Investopedia's definition of market risk. Market risk is the possibility for an investor to experience losses due to factors that affect the overall performance of the financial markets. Market risk, also called systematic risk, here you go, cannot be eliminated through diversification. You see, that cannot be eliminated through diversification. In the old days, we would always tell you, spread your risk out, invest in a whole bunch of different things, and you're going to be okay. What we've seen in the last couple of market downturns, and especially in the crash in 2008, the Great Recession, you couldn't spread out and diversify away risk. Big, big challenge going forward, something we're watching very, very closely. We shared this slide last year, and I think it bears looking at once again this year, that you see the red line is what we call margin debt. In other words, borrowed money in the stock market. The blue line is the stock market, and we're going back about 20 years. And you're going to see these two lines follow along pretty closely. If you look back in history at market crashes, 1929, 1987, 2000, 08, the common denominator was always too much borrowed money in the stock market. You see here, we had a peak in March of 2000 in that tech bubble of borrowed money. What followed it? Well, a market crash. You saw another peak in July of 2007. That was your housing bubble. What followed that? Of course, the market crash in 2008. In the upper right, you see June of 2016. We are here. We have more borrowed money than we ever have in history in the market. This concerns me a great deal. Not only do we have the most borrowed money, but we also have a very highly valued, very expensive stock market. So what this chart is showing, and we looked at this again last year as well, is the most expensive markets in history. So the most expensive market ever was that tech bubble, say March of 2001, prior to the terrorist attacks at 9/11 in 01, and that was the most expensive market in history. What followed was a market crash where you lost almost half, where you lost 49.1% of market value during that crash in 2001-02. The third most expensive market was August of 1929, right before the crash in October that began the Great Depression. The fourth most expensive market in history was that December of 07 before the Great Recession and the market crash in 2008. The market actually lost almost 57% during that crash in 08. Well, as you can see, we are here. We have the second most expensive market ever, fueled by the most borrowed money ever. Again, big, big concern. One common question we get is, how does the presidential election affect the market? Well, ordinarily, all years, the market's going to be up about 7.5% on average through all years. In presidential election years, the market's going to be down just slightly lower, 7%. Market will be up 7%. But what about election years like this one coming up in 2016, where we will have an administration change? What has the market done historically then? Well, in election years where a new president must be elected, bottom left you see the market's averaged a loss of 4%. Keep in mind, we had a administration change in 2000 after that election, and in '08 after that election, and those didn't end very well for the stock market. Again, something that bears watching. So what are we doing with your money? What do we see right now, and what are we doing? What actions are we taking? You're looking at a chart of the market, again, going back about 2 years, and this is a sort of a retake of that first slide where the market's basically where it's been. So we spent almost 2 years on the roller coaster up down, but we're ending about where we're starting. So last year when we visited and we talked about these slides, we were very concerned about a market decline. Sure enough, about 6 weeks later, middle of August, we had what's called a death cross, where our risk line, our long-term moving average line, crossed over and got above our short-term moving average line. That's called a death cross. That's a sell signal. So we sold. And we bottomed out here, and you see with our flat line here, we bottomed out back in September, October of last year, last fall. My concern then, and my concern now, is that the market here didn't act like it does at normal market bottoms. In a normal market bottom, you're going to see a whole lot of selling. You're going to see panic selling. You're going to see what we call capitulation, where a market with a whole lot of conviction, everybody is panicking and selling stocks. That's generally when good tradable market bottoms are formed. That's not what happened last fall. Sure enough, we had this little fool's gold rally. In December, we had our little sort of kind of mini Santa Claus rally. We got a buy signal middle of December, followed by 3 weeks later a sell signal, another death cross. Okay? And what you saw then, the first part of this year of 2016, was a pretty big drop into January through mid-February. That was a pretty precipitous drop, and notice we went lower than we did last fall. That line, where that flat black line is at about 1,800 points, 1,800 on the S&P. We believe that 1,800 line is the Alamo. If the market can go back down to that line, and we think that it will, and hold that price level where buyers move in, we think we'll probably be okay. If we do not hold that 1,800 level on the S&P, we believe there is great, great danger below that price point. If the market cannot maintain and hold that price level, we may have some big problems if it doesn't. Big, big concern that we have. Something that we're watching for you every single day. And lastly, a word from our lawyers. We want to thank you so much for tuning in. Once again, this is Lance Browning, Income Solutions Wealth Management in Tyler.